An investigation will come to order. Today's hearing is entitled Oversight of the Federal Housing Finance Agency. Without objection, the chair is authorized to declare a recess of the subcommittee at any time. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. Without objection, members of the full committee who are not members of this subcommittee may participate in today's hearing for the purpose of making an opening statement and questioning our witness. The chair now recognizes herself for 4 minutes for an opening statement. The Federal Housing Finance Agency, FHFA, was established as an independent regulatory body tasked with supervision and regulatory authority of the government-sponsored enterprises, GSEs, which include Fannie Mae and Freddie Mac. In recent years, FHFA has taken on an additional, somewhat unique role, acting as the conservator of Fannie and Freddie. As conservator, FHFA is tasked with decreasing taxpayer risk, which roughly stands at $5.3 trillion, while promoting the role of private capital in the mortgage market. Unfortunately, acting as both a regulator and conservator of Fannie and Freddie creates an obvious conflict. FHFA should be shrinking, not expanding its powers outside the scope of its congressional mandate. Today's hearing will highlight the need for Congress to build a consensus on a more balanced approach to home ownership that relies less on taxpayer subsidies and more on private capital and free market incentives. Since 2008, U.S. taxpayers have invested nearly $193.5 billion into Fannie and Freddie alone, leaving serious concerns about their future. As to FHFA's role as regulator, combined, the GSEs represent one of the largest financial institutions in the world, with trillions of dollars in assets. In recent testimony before this committee, FHFA Director Mel Watt noted that absent a conservatorship, both Fannie and Freddie would be considered systemically important financial institutions, SIFIs. While other SIFIs are supervised and regulated by the Federal Reserves, Fannie and Freddie are not. Unfortunately, it appears that the FHFA regulators are not up to snuff. FHFA is a young regulator, and the IG has identified repeated flaws in supervision. Even more concerning, in my view, is the fact that FHFA has failed to accept and implement all of the IG recommendations designed to fix this issue. As the IG put it in a 2016 report titled, "Safe and Sound Operation of the Enterprises Cannot Be Assumed Because of Significant Shortcomings in FHFA's Supervision Program for the Enterprises." In this regard, the subcommittee is particularly concerned about the GSE's cybersecurity infrastructure. The increase of cyber threats targeting our financial system has increased dramatically over the last decade. The number of attacks targeting financial services companies rose by more than 80% last year alone. The Inspector General has previously reported that FHFA did not complete any of its supervisory activities planned for the 2016 examination cycle relating to Fannie Mae's cybersecurity risks. Ultimately, ensuring that the GSEs are protected from all cyber threats falls to Director Watt, and the members of this subcommittee should be concerned whether an entity controlling highly sensitive data, controlling trillions of dollars in assets, lacks proper oversight. In addition to the reports on safety and soundness, the IG's reports raise serious questions as to whether FHFA is appropriately exercising its authority as conservator to ensure that they are good stewards of taxpayer money. In particular, under conservatorship, Fannie Mae elected to relocate a number of its facilities, including its headquarters in Washington, D.C. According to a report from September 2017, the Office of Inspector General questioned upgrades and finishes that pushed the total renovation cost to $32 million. Again, I want to thank the Inspector General for her time this morning, and I look forward to her testimony. I now have the privilege of recognizing the gentleman from Texas, Mr. Green, the ranking member, for 5 minutes.
Thank you very much, Madam Chair. I thank the IG for appearing, and I'd also like to just briefly recognize the presence of a former member of the committee, Mr. Garrett. He and I rarely agreed on anything, but we remain friends. And welcome to the committee again, Mr. Garrett. I'd like to also, if I may, compliment Mr. Watt for his impeccable service, his stellar character. He is a person who has been on this committee, served with distinction on the committee, and is someone that is highly respected in the industry. And I'm pleased to call him a person that I have great confidence in as the director of FHFA. I would in no way diminish the value of this hearing. I believe that it is an important hearing. But I also contend that there are some other things that we should look into. And I'd like to cite just a few. Wells Fargo may be fined $1 billion for auto insurance and mortgage lending. I've got several articles here, one from MarketWatch that styled CFPB may fine Wells Fargo as much as $1 billion. Another that I won't cite presently, but I'll place in the record at a later time. I'd like to, at some point, visit with HUD about the disaster relief, the recovery effort in Florida, Texas, Virgin Islands, Puerto Rico. Very much concerned about this. We had a field hearing in Houston just last week on this issue, and there are many housing issues that are of concern to persons in these various areas. We need to at least find out how the money will get to some of the recipients. For example, will there be a direct funding to a city like Houston that has received funds directly before, or will the funds go through another layer of the bureaucracy such that it may take additional time, which means that people will continue to suffer? Also concerned about the stripping of the CFPB's Office of Fair Lending's enforcement powers. I think that it was very good, Madam Chair, to hear from Mr. Mulvaney yesterday. But I do believe that there are two sides to these stories, and the advocacy groups have a voice. That voice ought to be heard such that we can better understand what's happening over at the CFPB. Are we really about to restructure it such that it will no longer be the watchdog that we intended and perhaps become some sort of lapdog? The CFPB is there for the consumer. It is the Consumer Financial Protection Bureau, not the Financial Systems Protection Bureau. And I think we need to look into this. I would also mention to you that invidious discrimination is still afoot in this country. Mr. Mulvaney said as much yesterday. And we know that Bancorp South has been fined at more than $10 million for discrimination, and that the finding was based in part on testing, where there were persons who were actually sent into the bank, had an experience with the bank officers in attempting to get loans, and it was determined that persons of color were treated differently when they went into the bank. They didn't have the same access to capital. Access to capital is important in this country. Invidious discrimination in banking is something that we can deal with. We can mitigate and eliminate this type of behavior in banking if we would use the tools that are available to us to acquire the empirical evidence, and testing is one of those tools. The CFPB has already engaged in testing as early as 2016. So these are some issues of concern too. Advocacy groups have a voice. We should hear from them as well. I appreciate what we will hear today. I've had the opportunity to peruse the testimony, and I look forward to hearing more and saying more about some of these other things as well. I will yield back the 2 seconds I have.
Gentleman yields back. The chair now recognizes the vice chair of the Oversight and Investigations Committee, the gentleman from Colorado, Mr. Tipton, for 1 minute for an opening statement.
Thank you, Chairman Wagner, and thank you, Ms. Wertheimer, for appearing before the committee today. The work of the Inspector General at the FHFA is of crucial importance. With the charge to oversee high valuation of assets backed by taxpayer dollars and broad discretion to exercise authority, FHFA has the potential to cause serious harm to the American financial system if it derails. As such, the work of the Inspector General to ensure that the FHFA is functioning properly and serves as a shrewd steward of taxpayer dollars comes into focus as essential. The witness before the committee today, Ms. Wertheimer, has worked diligently to study the practices of the FHFA and make recommendations to keep the agency in check. I look forward to her testimony and to hearing her thoughts on whether or not the agency has adhered to her recommendations. And again, I would like to thank the chairman for holding the hearing and the witness for appearing. I yield back.
Gentleman from Colorado yields back. We now welcome our witness, Laura Wertheimer. Today's witness, Laura Wertheimer, was confirmed Inspector General of the Federal Housing Finance Agency by the U.S. Senate in 2014. Ms. Wertheimer oversees a staff of 135 professionals who are dedicated to promoting economy, efficiency, and effectiveness in all FHFA programs and operations. Before arriving at the FHFA, she worked in private practice, receiving her law degree from Columbia University. Once a witness has finished presenting her testimony, each member of the subcommittee will have 5 minutes within which to ask questions. With that, the witness will now be recognized for 5 minutes to give an oral presentation of her testimony.
Chairman Wagner, Ranking Member Green, members of the subcommittee, thank you for inviting me today to testify regarding the work of the Office of Inspector General for the Federal Housing Finance Agency. Effective oversight makes government better and fosters effective change. Healthy skepticism through independent reviews, both by inspectors general and by Congress, acts as the disinfectant of sunlight to ensure a more efficient and effective government and to identify problems, abuses, and deficiencies. Because FHFA has unique responsibilities in its dual role as supervisor and conservator of Fannie Mae and Freddie Mac, and as supervisor of the Federal Home Loan Banks, FHFA OIG's responsibilities are broader. Making the right choices about what we audit, evaluate, and investigate is critical. Our work plan is risk-based. It focuses on 4 major management and performances challenges facing FHFA. My oral remarks this morning focus on one portion of those challenges, FHFA's supervision of Fannie Mae and Freddie Mac. During my tenure, FHFA OIG has issued 29 reports involving FHFA's supervision program for the enterprises and 56 recommendations to address shortcomings and deficiencies that we found. FHFA agreed in full to 38 of them, or 68%. We found that the design and execution shortcomings burden FHFA's supervision program, and we identified 4 recurrent themes. First, many FHFA supervisory standards and guidance lack the rigor of those issued by other federal financial regulators. Second, the flexible and prescriptive nature of many FHFA standards and guidance has resulted in inconsistent supervisory practices. Third, where FHFA issued clear standards and guidance, examiners have not consistently followed them. And fourth, FHFA lacks adequate assurance that its supervisory resources are devoted to examining the highest risks of the enterprises. Based on our work, we have cautioned stakeholders that the safe and sound operation of Fannie Mae and Freddie Mac cannot be assumed because of the significant shortcomings in FHFA's supervision program. While the Deputy Inspectors General of our audit and evaluation offices have recently observed some signs indicating improvements in the supervision program, it is too early to assess whether these improvements are significant and sustainable. Clearer standards and guidance, training, responsibility, and accountability are necessary to remediate the shortcomings and deficiencies we have identified. At this juncture, we have not identified sufficient, sustained improvements to warrant removal of our caution. During my tenure as Inspector General, we have issued a total of 85 reports to alert FHFA leadership and our stakeholders to significant issues, which include 117 recommendations to address identified shortcomings and deficiencies. Of those 117, FHFA fully agreed to 95, or roughly 81%. During the same period, we questioned costs of more than $104 million. Our civil investigations during this period resulted in more than $22 billion in judgments and settlements for the federal government, and our criminal investigations resulted in more than $784 million in fines, penalties, and the like. I thank this subcommittee for the opportunity to testify today. I'm happy to answer any questions that you may have. Thank you.
The Chair thanks the witness for her opening statements, and the Chair now recognizes herself for 5 minutes for questioning. Ms. Wertheimer, are FHFA statutory supervisory obligations similar to the obligations of the Office of Comptroller of the Currency, the OCC, the Board of Governors of the Federal Reserve System, the Federal Reserve, or the Federal Deposit Insurance Corporation, FDIC?
We have compared, the answer is short, yes, they are.
If it's fair to compare these agencies' requirements and guidance, how would you assess FHFA's standards against the other federal financial regulators?
We've reported on this in a number of our reports. Based on those reports, I would provide you with this assessment. They are far more flexible and far less prescriptive than the guidance and requirements issued by the OCC, the Federal Reserve, and the FDIC.
Is there a reason why FHFA's standards differ so greatly from the other federal financial regulators?
FHFA maintains that that Fannie Mae and Freddie Mac, and when I talk about supervisory standards here, and the differences, I'm talking largely about the supervisory program for the enterprises, not for the federal home loan banks. Because the federal home loan banks, FHFA does have far more prescriptive guidance that is far closer to the OCC and the Federal Reserve. The guidance is different when it comes to the enterprises. The position of the FHFA has been that Fannie Mae and Freddie Mac are not depository institutions, and so much of the guidance and requirements that the OCC and the Federal Reserve have issued are not applicable. As you know from our reports, we don't agree with that assessment.
Yeah, nor do I. Have you asked FHFA to improve its requirements and guidance?
In multiple reports, we have recommended that FHFA compare its flexible requirements and standards to those of the OCC, the Federal Reserve, and the FDIC. Some of those recommendations they've accepted, some they have not.
Reading your reports, it appears FHFA has consistently rejected your recommendations to revise its requirements and guidance to align them with those adopted by other federal financial regulators. What basis did FHFA give to reject your recommendations?
That it has the authority to issue its own requirements, standards, and guidance, and that's what it's done.
Together, Fannie Mae and Freddie Mac, collectively the enterprises, own or guarantee about $5 trillion in mortgages and are among the largest financial institutions in this country. Should either enterprise sustain losses that exceed their decreasing capital reserves, the Treasury, and thus the American taxpayer, will be on the hook for those losses. FHFA is statutorily required to ensure the safety and soundness of the enterprises. Without prompt and robust attention to address the shortcomings that you have identified, can safety and soundness of the enterprises be assumed from FHFA's supervisory program?
Well, as we cautioned, as you noted in your opening statement in our December 2016 report, which was a roll-up of 12 prior reports, we cautioned our stakeholders that safety and soundness could not be assumed just because there was a supervisory program, unless the deficiencies in that program were corrected. Now, we are not the backup regulator for FHFA, and a decision of safety and soundness, which HERA vests solely in the FHFA director, is based on factors other than a supervision program. So I have no opinion on whether they are operating in a safe and sound manner. I can only tell you that the supervision program should not allow anyone, the existence of a supervision program should not allow anyone to assume that the enterprises are being operated in a safe and sound manner.
Well, there you have it. I thank you. The chair now recognizes the gentleman from Florida, Mr. Christ, for 5 minutes.
Thank you. I yield my time to the ranking member. Thank you, Madam Chair.
I thank the gentleman very much and appreciate his fine service on this committee and his sharing the time with me today. For edification purposes, I did mention Florida earlier and our need to engage in some sort of oversight as it relates to HUD's transference of funds to the various states that have had some difficulties with the hurricanes. Let me please start where you were ending in terms of safety and soundness. You indicated that we should not assume that there is safety and soundness. Is that a fair statement?
No, I don't think it is, sir.
All right. Would you correct it then? Because I think it's been misunderstood.
What I have tried to convey in our reports and in my prior answer to Chairman Wagner is that the existence of a supervision program should not lead stakeholders to the conclusion that the enterprises are safe and sound.
Excuse me if I may intercede. Thank you. Should we assume that they're not safe and sound?
As I said before, we have not done sufficient
Well,
work.
but here's what you're doing. By emphasizing it the way you are using the language, you're leading people to believe that they may not be safe and sound. And that is not what you intend to do. Am I correct?
I respectfully disagree with you,
You
sir.
do intend to cause the public to believe that they are not safe and sound?
No, sir.
Well, then you and I agree. That the public should not conclude from your testimony that they are not safe and sound.
That decision is vested by statute solely in the FHFA
I do agree
director.
with you, but I don't agree that you should allow the verbiage to cause conclusions that are erroneous. Let's move on. Mr. Watt has indicated that they are not depository institutions,
Correct.
Which is correct. And that does make a difference, does it not?
For some of the requirements and guidance, you wouldn't need guidance or standards that apply to the taking of deposits.
But for others you would. You said for some, but for others you would.
Right.
What about the others? Are they in conservatorship? The Fed, FDIC, OCC? They're not.
They're not.
They're not. So Mr. Watt has a dual purpose, if you will. He has more than the other agencies have as a responsibility. And as a result, comparing them can be difficult. But I appreciate your attempt at doing so. Now, you indicated that he accepted, or excuse me, FHFA accepted 95 of 100 and was it 18 recommendations?
17.
117 recommendations. 95 of 117. Has it been your experience that the other regulators always accept 100% of your recommendations?
I don't have experience in that, sir. I've only been the Inspector General of the FHFA.
Well, based upon your reading, you're widely read, based upon your understanding of what happens at the other regulators from other intelligence that you have acquired, do the other regulators accept 100% of the recommendations all the time?
I don't have a factual basis to answer that. 95% is a high percentage of agreement with our recommendations. There's no question about that, and it is why I wanted to make that point to this subcommittee.
Well, I greatly appreciate you making that point, and I will welcome my visit with you a little bit later. I'll yield back the balance of my time for now.
Ranking member yields back. The chair now recognizes a gentleman from Colorado, the vice chair of the Oversight and Investigations Committee, Mr. Tipton, for 5 minutes.
Thank you, Chairman. Ms. Wertheimer, Section 1123 of the 2008 Housing Economic Recovery Act establishes that any new product offered by one of the enterprises must be examined and approved by the director of the FHFA, and each request to offer a new product must be subject to a 30-day public comment period. Recently, Freddie Mac announced a new pilot program referred to as the Integrated Mortgage Insurance, or IMAGIN, that did not comply with her statutorily required public comment period, nor was it publicly approved by the FHFA. Have you heard any explanations from the director or other relevant employees as to why this process was not adhered to for the IMAGIN program?
That is not a program that we've examined, and I lack any basis in which to answer that question.
Okay, well, thank you. You know, your office recently issued a report in March about another program, Single-Family Mortgage Underwriting Standards and Variances, where you report that the FHFA has continuously failed to implement your office's best practices recommendations for full visibility into the program's single-family underwriting standards and risks. FHFA has repeatedly laid out the courses of action to your office and failed to follow through on these plans. Why hasn't FHFA adopted those standards, and what can be done about their lack of adherence?
As you know, that recommendation stemmed from a 2012 audit in which FHFA agreed that it needed greater visibility into the single-family mortgage underwriting policies and variances because that is the foundation on which mortgages are written for single-family buildings. And the FHFA proposed to issue and did issue in 2013 a single-family process in which that review was, by which that review would be accomplished. In 2015, our Office of Compliance and Special Projects, and let me just say, that is an office that was created during my tenure because my view, based on my experience in private practice, is that you need to hold entities' feet to the fire. It's not enough for them to say they're going to do something. You have to go back and test whether, in fact, they have done it and whether, in fact, it remediates the deficiency that gave rise to the recommendation. In 2015, we went back and looked, and we found that their process was not complied with by either enterprise. One enterprise submitted everything, and one enterprise submitted, I believe, only 5. and the head of the office claimed to us that she lacked visibility into the mortgage, single-family mortgage underwriting standards for that enterprise. The FHFA agreed with we reopened that recommendation, and we were told that they would remediate it. There was a 2016 process that was issued. It was not followed by either enterprise. The FHFA then began another effort to come up with a process they would follow. They've now committed that they will have fixed this by March 31, 2018. I won't know about that till we go back and fix it. It has been 6 years since we recommended that they improve their process, and they have not. Is there a reason for that? As you know from our report, sir, there was the woman who was running the program had escalated her concerns within FHFA. FHFA had the authority as conservator to revise the letters of instruction and direct the enterprises to follow the process. It did not.
You just described 6 years of failure to comply, talked about the importance of holding their feet to the fire. As you noted, what are the repercussions if the enterprises are not in compliance with the recommendations from your office?
Well, Congress has chosen to give inspectors general the power of the bully pulpit, and that's about it. I have no, and neither do any of my fellow inspectors general, have any authority to require entities to do anything. We can recommend items that we think are practical ways to fix deficiencies, but we are at the mercy, if you will, of the entity we oversee to make those changes. All we can do, or I believe all we can do, is to go back, as we have done here, and call out the failure to follow those recommendations.
Thank you for that. And, Chairman, I would think it would be appropriate for us on this Imagine program, given what we've just heard, to be able to request that you would look into, Ms. Wertheimer, into the practices surrounding that Imagine program and the processes that led to its implementation, because we seem to be seeing a failure to comply statutorily and to sound recommendations coming out as well. Thank you, and I yield back.
Absolutely, we'll make that a formal request to the IG. The gentleman yields back. The chair now recognizes a gentleman from Michigan, Mr. Trott, for 5 minutes of questioning.
I want to thank the chair for setting up this hearing this morning, and thank Ms. Wertheimer for her time and for her work in what I'm sure is a difficult job. The summary you gave of your written testimony was troubling, perhaps even shocking, when you consider that we're talking about $5 trillion of exposure to the taxpayers. I want to ask a few questions about some things you said. The $484 million of fines and penalties, can you elaborate on and give us some examples of what some of those penalties might have involved?
I misspoke, I believe, and tried to correct myself. I believe we're talking about the criminal fines and penalties.
Right.
The number is 784 since October, $1 million since October of 2014. Right. Those arise in, we have an Office of Investigations. We are the law enforcement arm of FHFA. Unlike some agencies that have, like the Department of Homeland Security has its own law enforcement branch, FHFA does not, and so we act as the law enforcement agent for FHFA. Those are criminal matters that our agents investigated, brought to the attention of U.S. attorneys and Department of Justice. Indictments were handed down, and claims were either tried and brought to verdict, or were pled out.
Okay.
So those are just. I think what your question is the $784 million related to misconduct of any kind by FHFA? Right. And the answer is it is not. Okay,
good. Thank you for clarifying that. So when you talked about the flexible supervisory standards and how they're inconsistent with the private sector and some of the oversight of the Fed and the OCC, what's the justification for that difference?
I think, as our reports make clear, the
Excuse me, Ms. Wertheimer, could I ask you to speak up just a little bit?
Oh, sure.
Thank you so much.
I'm sorry.
Pull the mic a little bit closer. Thank you so much.
Okay. As our reports make clear, in any number of areas, we have compared FHFA standards to those of the Federal Reserve, right, or the OCC or the FDIC. Apart from the assertion that they are not depository institutions, the response has been, we make our own rules. We do it the way we want to do it.
You said that earlier in response to a question. And do you think any of the reasoning is perhaps motivated by a political agenda, which is basically we need differential treatment for the GSEs because some believe, I'm not among them, that the federal government needs to be involved to whatever extent necessary to make sure every American should own a home? Is there a political motivation behind this disparity?
I have not seen any evidence of that.
Okay.
I think under HERA, the agency has dual responsibilities. They may be in conflict, but they're dual.
Okay.
And to ensure the safety and soundness of these enterprises is a requirement of HERA.
Don't you think a good argument can be made that an entity that's in conservatorship should be subject to more rigorous standards?
I think it should be subject to at least the same standards that the Federal Reserve applies to SIFIs.
Let's talk about your 117 recommendations, 95 of which you said they agree with. How many have they actually implemented? It's one thing to agree with the recommendation in concept, but then to take action to implement the change or recommendation is another thing.
It is. Let me give you those numbers because I have them. Just give me a moment. Of the 117 recommendations we've made, in which they've agreed to 95, we have 74 of them are closed, meaning they have submitted to us in this situation evidence of compliance or implementation, and we have determined that based on what we've received, there is evidence of some implementation. There are 43 that remain open.
Okay, great, that's helpful, thank you. Now, my friend from Texas took issue with your testimony insofar as you suggested that because of the inconsistent application of standards and oversight, we really can't properly assess the risk profile of the GSEs and whether they do pose a systemic threat. I think that on its face is significant, just whether you're suggesting they're at risk or not. Isn't that something that should give us pause, that we can't properly assess where the GSEs are today because the standards are either unclear or not applied consistently?
We chose our words carefully when we wrote the roll-up report, and with the title of Safety and Soundness Should Not Be Assumed. It is typical, I think, for stakeholders to believe that with a supervision program that is robust, that everything is fine, that there is no problem with the regulated entity. Our point here was the supervision program exists, there are deficiencies, they haven't been corrected. There may be fine reasons for Director Watt to conclude that they are safe and sound, and that is his mandate, and we've not gotten out of our lane and rendered any opinion on that. But the supervision program, based on the 29 reports we've issued, has significant deficiencies.
Thank you so much. I'm out of time. I sure hope they're safe and sound because, you know, someday Freddie Mac's going to need $100 million to build out its offices like Fannie Mae. Thank you for your time this morning.
Gentleman's time has expired. The chair now recognizes the gentlewoman from New York, Ms. Tenney, for 5 minutes.
Thank you, Chairwoman Wagner, and thank you, Ms. Wertheimer, for coming here today. I just have a couple of quick concerns. And one of mine is obviously your entity is either stores, processes, or has control over $5 trillion in secondary mortgage assets. And when it comes to personal information and the storage of that, especially dealing with the mortgage, the confidential information that you hold for people all across the nation, it indicated that you have not done any supervisory activities dealing with cybersecurity in the 2016 examination cycle. Can you comment on that and tell me if that's something in the works in light of Equifax and so many of the breaches we've had and the constant attempts on government to breach into our sensitive security measures?
Look, since cybersecurity for me has been a top priority. was a top priority when I was in the private practice of law. It remains a top priority. As the Inspector General and the Office of the Inspector General, we do not have personal information regarding the mortgages that are purchased or guaranteed by Fannie Mae and Freddie Mac. That data resides with them, and FHFA is the concern.
Can I reclaim my time from it? Resides with them, meaning the banking institution or the individual holders?
It resides first with the originator of the loan.
Right, okay, the banking institutions.
Then, if to the extent that those mortgages are purchased by Fannie Mae or Freddie Mac, it resides with those two enterprises. FHFA as conservator can access, because it has the right, title, and interest under HERA as conservator to obtain it. We do not, because we're the Inspector General. If we are looking at a particular loan program, as we did recently with respect to the 97% loan programs that were begun in December of 14, we can ask for specific data on specific mortgages. We don't have that data in our database. Now, your question, I think, as I understood it, went to why did FHFA's supervisory plan for the 2016 supervisory cycle planned a number of supervisory activities to examine Fannie Mae's cyber risk management practices. As our audit found, it concluded none of those activities. Does that concern me? You bet. Does it keep me up at night? You bet.
Let me ask you something further on that, because I appreciate that it's a big concern, and I did a lot of mortgages in my past life as a bank attorney. Much of this information, and we did a lot of GSE type loans backed either by numerous organizations. A lot of this information actually is in the public domain, registered with banking, requirements by state law and federal law, where these loans are actually being recorded with clerks across the country, county clerks, particularly in New York State. I know where I reside. And so my concern is that, those are requirements coming from the FHA and from your side as well. So all these documents are in the public domain with county clerks. Is there anything that you do to guard the consumers against the type of these filings that could provide exposure to cyber or personal theft of whether it's social security numbers, addresses, banking information that end up in a county clerk's? Is that something that you would guard against when you're actually approving a loan or providing a secondary mortgage market to them?
Yeah, so again, we don't do any of that. We are here to look at what FHFA has decided to do with that information as conservator.
But wouldn't that be an oversight function you would have when you go to make sure that these things aren't disclosed as part of your whole package of providing some kind of protection for consumers when their personal data could end up online when they actually go to seek some kind of loan with, a secondary mortgage loan?
So let me try to explain that. FHFA has delegated as conservator to the enterprises the responsibility for cybersecurity protection. It is up to the enterprises to put into place rigorous controls to either prevent the inappropriate disclosure or at least mitigate that risk.
Right. If they don't take that, what is your action if that's not done? Because you've indicated that there was no protection in place under the 2016 guidance. So what would you do to protect the consumer going forward? Is something you would do proactively now in light of what the 2016 showed that you didn't do?
Okay. So we didn't. It's not that we didn't do it. FHFA develops a supervisory plan every year, what it's going to examine. What we do is go back through our audit and evaluation function and determine whether they in fact affected their supervisory plan. We had 2 audits we issued in 2015.
I think my time has expired. Can you quickly get to, so it covers cybersecurity risks?
Absolutely, and that's what our 2016 audit found, that in fact, notwithstanding the plan, they had not conducted any of the planned activities. We wrote about it to call it out to our stakeholders. Yes, we're concerned. We think it is an unsafe and unsound supervisory strategy. And that is what we reported.
Thank you for your testimony. Thank you.
Gentlelady's time has expired. The chair now recognizes my friend and colleague, the gentleman from Missouri, for 5 minutes.
Thank you, Madam Chair. Ms. Werthmeyer, thank you for being here. I work a lot with the Federal Home Loan Banks and of Des Moines, and one of my concerns is federal home loans and FHFA, their connection. I don't understand. You have as the IG, you have the responsibility, I'm assuming, for both. If you had your druthers, would you see that, would you want to disconnect between the two?
As you know, until 2008, they were disconnected.
Yes.
The Federal Home Loan Bank Board supervised, and its predecessors supervised the Federal Home Loan Banks, and OFEO supervised Fannie and Freddie. Decision was made by Congress to put them together. Our experience as the Inspector General overseeing the supervision of the Federal Home Loan Banks by FHFA has been, that supervision has been pretty good. For a number, there are a number of factors you can draw from our reports as to why that is. The guidance is different. I mentioned previously that the guidance and requirements that are in place for the enterprises are very flexible. That isn't the case with the Federal Home Loan Banks. That guidance and requirements tend to be far more prescriptive and much more similar to that of the OCC and the Federal Reserve, number one. Number two, by statute, the supervisors are required to examine the Federal Home Loan Banks every year. Our experience is, in fact, they complete that mission and issue reports of exam on time. They issue them to the boards of directors as their requirements provide, and they get a certification from each board, and we've looked at this in our reports, that not only the board has reviewed it, but has agreed to remediate any deficiencies identified. In the 10 reports we have issued of the 85 that involve the Federal Home Loan Banks, and many, I think it's fair to say 6 of them, compare the Federal Home Loan Bank examination practice to the supervision practice for the enterprises. We found it far more rigorous. They adhere to their standards, and we have only had 2 recommendations to address deficiencies or shortcomings we identified, both of which were adopted by the FHFA and implemented. Well, so at this point in time, there's this is a congressional decision, but I would say to you the supervision of the Federal Home Loan Bank seems to be working quite well.
Well, that's good news to me and probably Congressman Green, because we were a part of putting them together. As we move further and further away from the economic collapse of 2008, I think it's worth exploring and examining many of the decisions we made that we believed to, at the time, to have been extremely important in dealing with what was going on in the country as it relates to housing. So I appreciate your, for me, that was feedback and some confirmation that the decision we made was the correct one. Madam Chair, I yield back the balance of my time.
Gentleman yields back. The chair now recognizes the gentleman from Georgia, Mr. Loudermilk, for 5 minutes.
Thank you, Madam Chair, and thank you for being here. And I can assure you that I'm very interested in what you have to say, and you will have time to answer the questions. I want to continue on with the theme that Ms. Tenney was asking about, and predominantly I want to talk about the cybersecurity at the GSEs. As you know, they store an enormous amount of data, and that is a big concern of mine. And I've said this over and over again. When I was in the military, worked in intelligence and in the IT field, we had the principle of you don't have to protect what you don't have. In other words, if you don't absolutely need the information, you need to get rid of it. Otherwise, you're responsible for protecting it, and you become more vulnerable. And I know that the GSEs have a tremendous amount of data, and especially with more than $5 trillion in assets. And I was wondering if you could tell me what cybersecurity controls at the FHFA are in existence that maybe your office has identified as problematic?
I don't think we've done the work that would lead me to have a basis for an opinion or to answer your question.
Okay.
It is what we have identified in reports we've issued is that FHFA itself has identified deficiencies in the systems. There were legacy systems, there was unsupported software, there's been, as you know, a change in philosophy between Acting Director DeMarco and Director Watt. Director Watt has repeatedly stated that his intention is to run the conservatorships until Congress develops a solution to housing finance. So if you're going to run the agents, the enterprises, as opposed to wind them down, you need to have the same kind of cybersecurity infrastructure that major financial institutions, other outside of conservatorship have. Given that money was not spent on cybersecurity, that's a misstatement. Given that the systems were not upgraded on a repeated basis prior to Director Watt's tenure, it is fair to say there has been an enormous emphasis on upgrading those systems and the software. And our reports talk about FHFA's issuance, if you will, of they're called matters requiring attention. They are the most significant supervisory deficiencies, and FHFA's oversight of the enterprise's efforts to remediate those deficiencies. But to your question, I'm not able to answer the precise systems that would fully respond to your question.
Maybe you could answer this. Do the GSEs collect and store personally identifiable information?
Absolutely.
And I mean, that brings a level of concern is, you know, the PII and the amount and the data. And do you know what type of PII that is included? Is it Social Security numbers, birth dates, names? Is it the
I think
entire
it's
gamut?
all of that and more. When I first joined FHFA OIG as Inspector General, we issued a white paper talking about kinds of information as well as the different ways that information was vulnerable to attack. And you know, we just saw, I think, last weekend that 2 major retailers had more than 5 million of their charge card holders hacked. I mean, hacking is a fact of life today. Yes. So to your answer, yes, they do have a lot of PII, and they retain it in connection with their business.
And just shift directions for the last few seconds we have in here. Are you aware of any type of lobbying type activities being done by Fannie and Freddie?
I'm aware that HERA prohibits that activity. Mm-hmm. It has not come to my attention that they are engaged in any lobbying on the Hill.
Okay, thank you. I yield back.
Gentleman yields back. The chair now recognizes the gentlelady from Ohio, Ms. Beatty, for 5 minutes.
Thank you, Madam Chairwoman, and to our ranking member, and thank you, Madam Inspector General, for your testimony and for your work and for being here today. In your report, one of your reports, you talked about the spending of the $171 million by Fannie Mae and its Washington, D.C. headquarters. I can remember when Director Watt was here. Many of my colleagues also talked about that and asked questions about it. And as I recall, there was a lot of time spent comparing it to reports of health and wellness for staff to be able to feel secure, to be able to walk, to not have to go outside and around to use the pathway. And since then, I did do some reviewing of other, whether it was private sector facilities, to see how employees felt about it. And certainly, I think it is not only the quantity of what we expend or put in something, but it is the quality of the outcome as well. So I just wanted to interject that. Additionally, you questioned the comps, I believe, used by the FHFA to justify its spending. I was really fortunate enough to be speaking at an event with the Ohio Association of Realtors at their annual legislative conference in Columbus, because we're celebrating the 50th anniversary of the Fair Housing Act. And while I was there to speak about the passage of that historic bill that was passed in 1968, it made me think about how realtors use comps in real estate business when I read your report and your testimony. In your testimony, you questioned the cost associated with Fannie Mae's new office spaces in Washington and in Dallas, Texas. You also questioned the standards or the comps used by the FHFA to justify some of these costs. And certainly the standards or the comps used by FHFA for justification of some of those costs was against the upgrades at major financial institutions and larger public sector agencies. To me, this seems to be a reasonable comparison. And while we've heard that Fannie Mae, I'll get this out of the way, is in conservatorship, it seems to me that it is a reasonable comparison because Fannie Mae is a large financial institution with a $110 billion revenue in 2017 and is controlled by a large public sector agency, the FHFA. So could you kind of share with me why did your report question the standards used?
Our report, all Inspector General's reports should, according to our own professional standards, contain 4 elements: condition, criteria, cause, and effect. Here, the condition was the build-out, what was being spent on the build-out. And the criteria was not a criteria that what J.P. Morgan Chase or Bank of America would spend. The criteria is set by this Congress in HERA. When an entity, a regulated entity by FHFA, is put into conservatorship, the conservator has an obligation to preserve and conserve. Now, what does that mean? In our first report in May of 2016, we set out our view of what that meant. What are the upgrades, if you will, that Fannie Mae has sought? What are their efficiencies? Do the efficiencies warrant the cost? And is the cost appropriate for an entity in conservatorship with an uncertain future in a building it does not own? That is how we understood preserve and conserve. In its response, FHFA didn't take issue with that standard. In fact, Director Watt in his response explained, well, there may be short-term costs to the spiral staircases, but over time, there are greater efficiencies. He offered the same with the walkways and said, yes, of course, we're going to consider cost efficiencies and whether it's warranted for an entity in conservatorship. We went back a year later to see what had happened. And what we found was we spoke to the Oversight Committee within FHFA, a committee that was put together in response to a recommendation, as well as the expert. And what we were told was, by each person we interviewed, and we report that in our September 2017 report, they didn't consider cost efficiencies. They didn't consider whether it was warranted for an entity in conservatorship with an uncertain future in a rental building to spend that kind of money. And for that reason, we came to the view that the standard wasn't met. Had we heard something different? And FHFA's response was, well, that we did consider cost efficiencies. That was not what our field work showed, and that's what we reported.
Thank you. Madam Chairman, in light of us not having enough members here, may I have an additional minute?
Without objection.
Thank you. Let me just say thank you for that, and we'll continue probably to have discussions on that and the quality of it and how narrowly focused sometimes we are when we're trying to make those determinations. And we know that there's not another building or entity like this, so it does make it very difficult from where I sit. But lastly, I want to thank you, and I also want to thank you for sharing with us the number of responses that Director Watt did provide. And I am pleased that you stated that that is a majority of being able to meet the standards and to meet 95 out of 100 and some. I want to thank both of you. And I'd also, Madam Chairwoman, just like to conclude, because we do spend a lot of time here, and we're fortunate to have a chairwoman of Oversight that allows us to get engaged. So maybe one of the things that we can continue to work on is for Congress to be more engaged in the actual housing finance reform. And I think that's one of the things that Director Watts, in his just maintaining it, I think he was waiting on Congress to be more engaged. So I think I'd like to say to Director Watt, who was one of us and served admirably here on this committee, that for the things he's been able to accomplish over there, it's been short of miraculous. It's a new entity. You being relatively new, the only second director there, I can imagine to have to always find things that are at fault or wrong can be very challenging. So I'd like to thank you for your service, and thank you, Madam Chairwoman.
Might I respond to one thing? We don't start our work with an objective that says, prove that FHFA failed to do X. We identify risk areas, we get input from our stakeholders, whether it's FHFA employees, members of Congress, reading reports issued by think tanks. We come up with project ideas. We then do the field work. We report what we find. I would only direct your attention to, for example, the 2 audits we recently issued on the 97% loan-to-value program. When that program was tried as a pilot program under Director Lott's leadership, there was a lot of criticism about that program, that it was opening the credit box unduly, that it was going to cause that it was putting taxpayers at risk because of the opening of the credit box. What we found and what we reported was a well over 97% rate of compliance by the originating banks with the requirements that FHFA established in December of 14. So we're not only here to find and report bad news, we're here to examine risk areas and report what we find, good or bad.
Thank you. That's a good note to end on, that there were some very good things found, and I really appreciate your adding that. Thank you.
Gentlelady from Ohio's time has expired, and I thank her for her comments, and I will say that I plan on in my close, talking about perhaps more ways, as you well put, Ms. Beatty, for this committee to be more, and Congress to be more involved in the process. Moving on, the chair now recognizes the gentleman from Indiana, Mr. Hollingsworth, for 5 minutes.
Well, happy Thursday. I appreciate you being here, and have to say that I've heard from so many people, both sides of the aisle, both staffs, how great, how diligent, how thoughtful you are at every turn, and really appreciate that. And I can assure you, my constituents, Hoosiers back home, rest well at night knowing that someone is watching all aspects of at least one area of government for them. I did want to talk about new products. And some of the new products that they're currently being offered, and some real concerns about those from 2 aspects. First aspect is the potential for them to transition from secondary market focus, secondary market activity, to primary market activity. I know that the Imagine product has been brought up, and I know that you don't want to address that directly, but I just want to talk about the general big concept here. of making sure that what I think is, if not written into the specific language of the charter, certainly the spirit of the charter, that these two entities would operate in the secondary market and are responsible for developing a robust secondary market, and that these products may be transitioning to the primary market. And I think the history of government-conferred advantaged companies entering into environments where others don't have those same advantages is one wrought with failure and problems. When you drop a lion onto the Serengeti with a bunch of antelope, you don't get more antelope and a more diverse species, you get a fatter lion. And so I wanted to make sure that some oversight was being provided to, that they are not transitioning from secondary market to primary market. And some of the newer products that are being offered aren't an attempt to do so, or in your mind aren't beginning that process of crossing that bright line that we've had for the last 50 years.
We haven't done the work for me to render an opinion on that. I certainly have heard concerns from 2 members of the committee about that, and we will factor that into our work plan.
Okay. But it is something, I guess, from a broader perspective that is worth watching, would you say?
Absolutely.
Great, thank you.
You know, we have a lot of, we do a lot of watching.
I have no doubt. I have no doubt. It is a big purview to watch, but you know, there are a lot of things that you can watch in small ways, and making sure that every taxpayer dollar is spent as effectively, as efficiently as possible. But this could be a really large problem down the road. It can create really catastrophic results for taxpayer losses in companies having these advantages and operating in an environment where others don't, especially where that same company gets to set the standards for others that might compete with that primary market. I think that's really important.
No, and I hear that. Yeah. We have established an Office of Risk Analysis precisely to monitor emerging risks, because the first Inspector General, Stephen Linick, who was very helpful in sharing his information about the FHFA and about the OIG with me, said, you know, this IG is unlike many IGs. You're not doing autopsies on contracts that have already been led and figuring out whether there's any waste, fraud, or abuse. You're operating on a live patient without a lot of anesthetic.
Yes.
So they're open institutions. When we speak, we have to be measured in what we say,
yes,
but we cannot close our eyes to emerging risks and just, oh my goodness, this catastrophe is upon us. And so, you know, we have, in the last semi-annual period, issued 3 white papers talking about adjustable rate mortgages, which are on the rise, custodial institutions, and the like. And we continue to, I mean, this is an area of emerging risk we need to look at.
And I love that you're focused on it, because ultimately we do have the economic tailwinds today, right? And that is the moment when risk gets built, that risk comes to fruition and comes to losses at times of economic recession. The last thing I wanted to talk about, the second point with regard to this, is you said an open institution. And one of the concerns that many have raised about some of the new products that are being offered is that they are being offered without appropriate public comment period beforehand, and there's not the same level of transparency that we had come to expect, or that taxpayers demand, or are written into the previous act. You have any comment? I think there are 4 new products that are now being offered without having gone through that 30-day public comment period that's required.
I don't. Okay. I'm sorry.
Well, that you are watching is important, and making sure that taxpayers not only are being looked out for on present and current expenses, but also for risk that may be building, or the emergence of risk in the system, or just the gradual grabbing of more and more purview by these institutions. That's what got us into the problem before, and I want to make sure that we don't have that same problem 10, 15, 5 years from now.
I do too, and it's why this Office of Risk Analysis is critical for us, as well as the fact that there have been many changes we've put into place, because my view is the financial crisis, if you were a student of housing finance, you may have been predicting it in 2004 and 2005. Most Americans, including myself, were sort of hit upside the head when it started and how fast it escalated. We don't have the luxury of taking 18 to 20 months to do an audit or an evaluation. We have got to look at something quickly, thoroughly, and report our findings, because if there are problems, we need to identify them, propose recommendations, and alert our stakeholders.
Well, this is an important area that certainly I, and as you alluded to, several other members are very concerned about, and would love to have your continued watchful eye on that. And as I started with, I've heard from everybody just how diligent and thoughtful you are. You have certainly resoundingly reinforced that opinion today, and I appreciate you being here.
Thank you very much.
Gentleman's time has expired. The chair now recognizes the ranking member, the gentleman from Texas, Mr. Green, for 5 minutes.
Thank you, Madam Chair. As I indicated earlier, I have some news articles that I'd like to place into the record. One styled CFPB may fine Wells Fargo as much as $1 billion. That's from Market Watch. Another from Reuters, exclusive, is U.S. watchdog seeks record fine against Wells Fargo for abuses. Another, this is from the American Banker, CFPB's Mulvaney strips his Fair Lending Office of enforcement powers.
Without objection.
Thank you, Madam Chair. Let's quickly go to the fines, the criminal fines. Who were these fines levied against, please, ma'am, Madam?
So they're all over the place. Some are against institutions. Some are against individuals.
Were any levied against FHFA?
Not, to the best of my knowledge, they were not.
Okay. When you say to the best of your knowledge, based on the empirical evidence that you have, none were. Is that correct?
I am not aware of any that were levied on, criminal fines levied on FHFA. I'm just not aware of any during my time.
Well, if there were some, you'd be aware, wouldn't you?
I surely would hope so.
Okay. Well, so why do you choose to engage in this sophistry to the extent that you leave the notion that there may be something shady there, but I don't know about it? FHFA hasn't had criminal fines levied against it. Has it? It has not. Let's move on. You indicate on page 11 of your statement to the committee, the full statement, page 11, first paragraph, last sentence, you indicate that the work that we do does not provide us with a sufficient basis on which to make such a safety and soundness assessment for either enterprise. You're talking about safety and soundness. And you indicate that your work doesn't provide you a basis for making an assessment of safety and soundness. Is that a fair statement of what you stated?
That is correct.
Okay. So if this is a fair statement of what you stated, why would you go on to make this statement that safety and soundness should not be assumed? Now, let me tell you why I'm pursuing this. In this area, your diction has to be superb. And it has to be superb because markets move on safety and soundness. We would not want the public to conclude that there may be a safety and soundness issue that you are aware of, but you're not reporting. You have no evidence of there not being, of there being something other than safety and soundness at FHFA. So I want to clarify this with you because you've stated it two ways, this language two ways in your report. In one, you use the language safety and soundness should not be assumed, but then in another, you indicate that your caution, however, should not be understood as our having concluded that the enterprises are not being operated in a safe and sound manner. Both of those are your statements.
Correct.
Okay. So can we say to the public that can cause markets to move based upon words that you articulate, can we say to the public that you are not here today to imply that FHFA is something other than safe and sound?
Well, FHFA is the conservator of these enterprises. It is also the supervisor. It's charged under HERA with making the safety and soundness decision for these enterprises and for the federal home loan banks. It's also charged with reporting that to the Congress every year. What we are saying is the public often assumes that the existence of a supervision program, that someone's on the beat, means the entities are safe and sound. And
are you concluding that the safety and soundness report from the authorized agent to produce such a report is incorrect?
I think I'm clear that we're not saying
Okay.
that.
So then you walked into this when you decided you were going to make a commentary about the safety and soundness when that really is not within the purview of your responsibilities. You don't make safety and soundness decisions about FHFA.
And we did not, sir, we never said we did.
All right. Well, I appreciate your being here today, and thank you for your testimony.
The ranking member's time has expired. The chair now recognizes the gentleman from Tennessee, Mr. Kustoff, for 5 minutes.
Thank you, Madam Chairman. Thank the witness for appearing this morning. We appreciate it. Your office prepared a number of reports describing the cost of building renovations for Fannie Mae. If you could you walk us through some of the improvements your office identified that you thought were noteworthy for their cost and expenditures?
I'd be happy to do that. We, as our first report indicated, received a whistleblower complaint on this. We set out, as we do with all whistleblower complaints, we triage them because we don't have the bandwidth to look at each and every complaint. We decided that this complaint merited an administrative inquiry, and we went about looking to figure this out. What we learned was that the landlord of Carr Properties had given Fannie Mae a very generous tenant improvement allowance by the terms of this area, $120 a square foot. And so what we were looking to see was, okay, are they spending within the tenant improvement allowance, which would cost them nothing, or were they in excess of the tenant improvement allowance? At that time, FHFA did not have an expert. Fannie Mae had retained an expert. Fannie Mae's expert told us that in its experience, $164 a square foot was what Class A is the best space you can get, and this is new space, but what you would expect a tenant moving into Class A space to spend on improvements and the like. We then looked at what the projections were, and to be clear, they were only projections at the time of what Fannie Mae planned to spend. At that time, they were roughly $252 a square foot, which was well in excess of what Fannie Mae's own expert said was customary, not necessary, but customary. We began asking questions. The gentleman at FHFA who was in charge of the oversight had told our investigators, golly, we have no exposure here. We're capped at $120 a square foot, and if Fannie Mae was going to exceed that, why, they would have told us that. Well, at that point, their own budget showed $252. I believe it may be $253 a square foot. We, in the course of our looking over 8 weeks, the budget went down to $235 a square foot. We issued the management alert in June of 16, in which we said, look, you're in conservatorship, Fannie Mae. You, FHFA, while you delegated the build-out costs to Fannie Mae, they're your agent. You're ultimately, as conservator, responsible for that. The statutory standard set by Congress is preserve and conserve. Whatever that means, it cannot mean $252 a square foot when law firms, lobbying shops, et cetera, are paying $164 a square foot. And we identified what, in our view, conserve and preserve meant, and I identified that earlier. What are the efficiencies? Do they warrant the cost? Are they appropriate for an entity in conservatorship in a space it does not own, and it may not be in existence for 15 years? So while I certainly appreciate employees enjoying open spaces and crystal walkways, et cetera, I can tell you I practiced law in a firm where the carpet was coming up, where the mail chute was jammed, and I had the best time of my life there. We didn't need to have luxuries in order to practice law well. But be that as it may, Director Watt agreed that our recommendations and the standard would enhance the oversight. And so we came back a year later because the last thing I wanted, or anyone in my office wanted, was for the building to open and for the Congress to say, well, where was that IG? So we went back. What's gone on? Well, we interviewed the committee that was responsible. We interviewed the expert who was retained. What did we find? Well, we've got a cafeteria that's being put in, which the expert said would be underutilized. We have a third generator, which was put in. The expert said, well, Fannie wanted it. We have a broadcast studio. Fannie wanted it. We have finishes, lunch huts, pergolas. It is, as the expert wrote in its report, it felt that the standard for the baseline, if you will, for Washington, D.C. had gone up from 164 to 175. I'm leaving out the change. So it only looked at improvements and upgrades above 175. And that's where that $32 million comes from. It's above and beyond the $175 a square foot.
Thank you very much. My time has expired.
Gentleman's time has expired. Without seeing any further members to question, let me close by saying that today's hearing has raised important questions that are extremely concerning. It appears that statutory discretion under HERA has led to a lack of oversight at the FHFA, which in turn has led to objectively bad performance as measured by the independent and nonpartisan IG. I hope my friends on the other side of the aisle see this and will work with us on reforming HERA. I also have to note that our concerns are exacerbated by the fact that Director Watt recently failed to substantially comply with a committee records request seeking to further explore the important issues raised by the IG, Director Watt's statutory discretion, and perhaps more importantly, Director Watt's failure to fully implement many of Ms. Wertheimer's common sense recommendations. Simply put, I will not allow failure to comply with committee records requests to stand. Again, I want to thank Ms. Wertheimer for her testimony today, and without objection,
Madam Chair,
all members.
I have a question. I would like unanimous consent to place a response to your statement in the record if that can be done without objection.
Without objection.
Thank you.
Again, I want to thank Ms. Wertheimer for her testimony today, and without objection, all members will have 5 legislative days within which to submit additional written questions to the chair, which will be forwarded to the witness. I ask for our witness to please respond as promptly as you are able to, and I thank the Inspector General for her frankness, for her courage, for her public service to our country, and her testimony here today. This hearing is now adjourned.